Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular Markets Review Breaking the Mould, I'm going to be looking at groceries, confidence and American jobs. All three of these topics look capable of causing a fuss in the week ahead, because we have first half results from supermarket chain Tesco on Wednesday the 5th of October, a trio of UK economic confidence surveys on Monday through to Wednesday the 3rd to 5th, and then the latest monthly US non-farm payrolls figure on Friday the 7th, a number that, in the short term at least, can be a huge influence on sentiment across a range of asset classes and geographies. So let's start with Tesco, a FTSE 100 firm looking to try and demonstrate to investors it's on the way back after a torrid couple of years. As we can see here, the shares are up some 7% over the past 12 months, so Chief Executive Dave Lewis may be persuading someone somewhere the firm is indeed getting back on track. June's first quarter statement offered some grounds for hope, as Lewis unveiled a 0.9% increase in like-for-like sales at the group level, based on a 3% gain overseas and a 0.3% advance in the UK and Ireland. Now, let's not get carried away here. I'm a great believer that life begins to the left of the decimal point, and it's therefore hard to get excited about any number that begins with 0. And those numbers also go to show groceries is still a tough business. Ocado's dished out a profit warning, Morrison has talked of more price cuts, and the dogfight for market share remains as intense as ever. So, let's see how the Tesco first half figures look on October the 5th. Besides the trend in like-for-like sales, you really need to check out operating margin, which was just 1.7% last year. Further progress in net debt reduction from last year's 5.3 billion after a number of disposals, including the Giraffe restaurant chain and Dobby's garden centres, and then the dividend. This was cut to 0 last year, and it'll be interesting to see if Lewis feels confident enough to reintroduce it. For the full year, analysts are looking for a 0.38 pence per share payment, and that may all come at the full year stage. Never know. Now, the good news for Tesco is that expectations are at least nice and low, and perhaps the same can be said for the UK economy, for which we'll get the latest snapshot in the form of 3 Purchasing Managers Indices, or PMIs, corporate sentiment surveys, in the next week. Monday the 3rd we'll get manufacturing, Tuesday the 4th construction, Wednesday the 5th services. Now, as we can see here, all 3 readings dipped badly in July after the June EU referendum vote and then rebounded in August. Then throw in one more line on the other y-axis on this graphic, the FTSE All Share, and you can see why these data points can be important. The PMIs generally led the All Share higher, lower, higher, then lower, you get the drift. So let's see what the trend is this time, especially as the All Share has begun to march smartly higher of late. The final big story of the week is likely to be the latest monthly release of America's non-farm payrolls data on Friday the 7th. So what, you might think. But the US is the world's biggest economy, and its central bank, the US Federal Reserve, has unwittingly or otherwise exerted huge influence over financial markets with its monetary policy. A really strong job creation figure could show the US economy is motoring, and the Fed may therefore look to raise interest rates, something that could actually cause a wobble if recent market action's any guide, not of course that the past is by any means a guarantee for the future. A weak number could show the US economy is losing steam after a 7-year uptrend, albeit a modest one, and stock markets may decide bad news is good news because it keeps interest rates lower for longer, something that's been driving money towards stocks relative to cash and bonds of late. We'll see. So much for the market psychology. The final graphic shows the monthly data going back to 2000 for non-farm payrolls, and then runs those figures against America's headline S&P 500 index. 2 things look to jump out. First, the job numbers do seem to influence the index, I guess, because a healthy economy means healthy corporate earnings, healthy cash flow, and healthy dividends. Second, recent momentum's been mixed job-wise, even as US stocks have moved higher. August's new jobs figure of 151,000 wasn't great, and that's your benchmark. Any figure near there could be taken to mean rates will be lower for longer. Anything well above it, and the markets may be on alert again at the Fed's November and December monetary policy meetings. So thank you for watching, and I look forward to seeing you next time.